those of you that don't like numbers, don't worry. This topic really doesn't need any more math skills other than being able to add, subtract, multiply and divide. Remember, try and write as if the examiner doesn't know anything about the subject so that you're forced to explain your ideas better. Right, we'll make a start at looking at the first section of accounting and finance. This is all about costs, profit, contribution and break-even. Let's start off with costs and profit. A lot of students get different types of costs mixed up and lose easy marks on definition questions. So let's get this clear. A cost is something a firm spends money on. Firms need to know what the costs are so they can work out how much money is being spent. If they don't know what the costs are, they can't work out if they've made any profit. A common way of looking at costs is to look at fixed or variable costs. The difference between them is really easy. Fixed costs don't change with output, and variable costs do. Fixed costs stay the same however much a firm produces. For example, a fixed cost is rent. This stays the same and has to be paid whether there's production or not. We can look at this on a chart. This will help you with understanding break-even. See how the chart shows costs going up here in contrast to output along the bottom axis? You can see that in this case, fixed costs are always £4 million, whatever the firm produces. Variable costs are different. These costs do change with output. The more a firm produces, the higher the variable costs will be. For example, materials used to make products. If a firm makes TVs, they're going to have to buy a lot more parts to make 70,000 TVs than to make 10,000 TVs. So these are variable costs which will go up. This is how variable costs would look on a chart. As you can see, you've got costs up the side and output along the bottom like before, but this time the costs rise with output. This is because they're linked to output. If the firm wasn't producing anything, the variable costs would be zero because they wouldn't need any parts. You've also got semi-variable costs, which have a fixed part and a variable part. For example, telephone costs are semi-variable because you've got the line rental that doesn't change, and so is the fixed part. And then on the top, you've got the call charges, which go up the more you use the phone, so are the variable part. Okay, so that explains the difference between different types of costs. You might also come across direct and indirect costs, so it's useful to know what they are. Direct costs can be linked to a product. For example, the raw materials used to make that product. So they're a bit like variable costs. Indirect costs, also called overheads, are costs which come from running the business as a whole, like admin costs or general marketing costs. It's harder to allocate them to a specific product, so they're a bit like fixed costs. Whilst we're talking about costs, you might also have heard of opportunity cost. It's not a cost like fixed or variable ones, but it's really relevant to businesses. Opportunity cost is the cost of what you've given up to get something else. An example really makes this easier to understand. If a business spends £50,000 on promotion, it may have to give up the opportunity of spending that money on buying new equipment. The new equipment could have made production more efficient, or they may have to give up the opportunity of spending that money on providing more staff and increasing motivation. Does that make sense? You can only spend the money once, and whatever choice you make will have consequences elsewhere in the business. It's a really good idea to look at this in the exam because it shows the examiner that you can see the wider implications of any suggestions you make. It's really important you get the difference between these two clear in your mind because revenue is not the same as profit. Revenue is the quantity sold multiplied by the price. So in a calculation, it looks like this. It doesn't look at profit because costs aren't involved in the calculation. In other words, profit is total revenue minus total costs. Total costs are fixed costs plus variable costs. It may be useful if you started to write down all the calculations on a separate sheet of paper so you can revise them easily. So, profit is what's left after costs have been taken away. Let's have a look at how profit could come up as an exam question. I want you to pause and spend about 10 minutes answering it. Here's the question.
To what extent is profit always an indication of success?
How'd it go? How did you find it? Let's go through some of the points you might have covered in your answer. It starts off with to what extent, so you know you're going to have to show evaluation skills and also knowledge, application and analysis. Profit is the key term in the question, so a good thing to do would be to define it to get some early content marks. You've probably pointed out that profit is important to shareholders because it means they get paid a dividend. This is why they buy shares. So for shareholders, profit does indicate success. I think it's important to say that profit can give the firm money to put back into the business. For example, money could go on staff training, so the staff might see profit as an indication of success. As this is an evaluation question using to what extent, it's important that you give a balanced answer and point out that there's another side to the story. In this case, not all firms focus on profit. For example, charities or schools don't put money above everything else. Also, some firms think that things like looking after the environment and social awareness are important. Like most things, it really depends on the type of business, the managers and their objectives. Okay, let's move on. We started off looking at different types of costs, and I mentioned that the charts we used to show costs would come up useful for break-even analysis. So, let's have a look at break-even. Break-even is the point where businesses aren't making a profit or a loss. They're just covering the costs, and total revenue equals total costs. Before we go on to calculating break-even and doing the charts, let's go through why break-even is useful for businesses. Break-even allows firms to work out how many sales they need to cover their costs. After this point, they'll start to make a profit. It can also show a firm how the break-even point changes if prices or costs change, so it gives the business a range of alternatives to look at. This information may also be useful to show a bank if a business is trying to get a loan. The bank will want to know just how realistic the break-even point is. Let's have a look at calculating the break-even point. You'll need to know the fixed costs, the variable costs, and the selling price per unit. The selling price minus the variable costs is known as the contribution. So if we look at the calculation, it'll look like this. So, break-even output equals the fixed costs divided by the contribution per unit. The contribution was worked out by taking away the variable costs from the selling price. remember that the contribution per unit goes towards covering the fixed costs. When these have been covered, the firm will start to make a profit. Why don't you pause and have a go? I'll give you the data and you can work out the break-even point. In other words, the break-even output. Okay, let's go over to Chris and find out about his surfboard business.
Hi, I'm Chris, and I'm going to set up a business selling surfing gear. I was thinking, if I sold each surfboard for, say, £200 each, and each board cost me, say, £80 to make, and my fixed costs are £120,000, what would my break-even output be?
How'd it go? Your answer should be 1,000 surfboards, and the way you worked it out should look like this. The break-even point equals the fixed costs divided by the contribution per unit. So if you put the figures in, you get this. The break-even point equals 120,000, which are his fixed costs, divided by 120, which is the contribution. This was worked out by taking the variable costs, in this case his materials, away from the selling price, which is £200. 120,000 divided by 120 equals 1,000, which is the number of surfboards Chris needs to sell to break even. Let's have a look at the break-even point when the selling price changes. Back over to Chris again.
So my fixed costs are 120,000 and my variable costs are £80 a surfboard. But this time I've decided to increase the selling price of each board to £220. Now, can you work out what the break-even point would be? This would really help me, so make sure you show all of your workings out.
Done it? Your calculations should look like this. The break-even point equals fixed costs divided by the contribution per unit. So if we put the figures into the calculation, it'll look like this. The break-even point equals 120,000 divided by 140, which is the £220 selling price minus the £80 variable costs. The break-even point is therefore 857. So, by increasing his prices, he brings the break-even point down and could make profit earlier because he wouldn't have to sell as many surfboards to cover all his costs. But it's important to try and be analytical wherever possible. Simply putting the price up won't necessarily lead to earlier profit because a higher price might put people off buying his surfboards. This is where knowing the price elasticity of demand comes in useful. You also need to remember that the results are only as accurate as the data used, and estimating figures can be quite difficult. Before we look at break-even charts, let's just look at another calculation you might be asked to do. You could be asked to work out the profit or loss at different outputs. To do this, you need to work out total contribution, which is the contribution per unit times the number of units and take away the fixed costs. So, if the selling price is £60 and variable costs are £40 per unit and fixed costs are £100,000, we can work out the different profits or losses at different outputs. First, let's work out the contribution per unit. The formula is selling price minus variable costs per unit. This would give us £60 minus £40, which equals £20. Right, let's work out what the profit or loss would be at 1,500 units. The calculation is total contribution minus fixed costs. So this would be contribution per unit times the output minus the fixed costs, which is £20, times 1,500 minus £100,000. This gives us £30,000 minus £100,000, which is minus £70,000, and therefore a loss. Now you have a go. This time, work out the profit or loss at 8,000 units. How'd it go? Your calculation should look like this. So that would be £20 times 8,000 minus £100,000, which is £160,000, minus £100,000, which gives £60,000 profit. Is that okay? If you're confused, go back and look at this bit again. So you could be asked to work out a break-even point or work out a profit or loss at different outputs. You might also be asked to draw a break-even chart. Let's go through this step by step. First of all, I'll show you where each line goes, and then I'll go through a chart using some figures. First, give the chart a title. Next, plot output on the horizontal axis here. Then plot revenues, costs or profits on the vertical axis here, and label them both. Then draw on the fixed cost line. This will always be a straight horizontal line because the fixed costs don't change. Then draw on the total cost line, which will run from the fixed cost line because total costs include fixed costs and variable costs. Then draw on the total revenue line, which starts from 0 in the corner here. Make sure that all the lines are clearly labelled. Where your total costs and total revenue lines cross is your break-even output. To the left of this point, the difference between the total costs and the total revenue line is loss, and to the right it's profit, because the total revenue is greater than the total costs. Now let's do a break-even chart using some figures. We'll use Chris's surfboard business as an example. Here's Chris with some figures.
Now remember, my surfboards sell for £200 each. The variable costs are £80 per board and the fixed costs are £120,000.
Let's use these. So, first of all, you give the chart a title. We could call it Break-Even Chart for Chris's Surfboards. Next, plot the output on the horizontal axis, like this. We'll put output going up to 2,000. Then you do the vertical axis for costs, revenues or profits, like this, going up to £400,000. The next thing to go on is the fixed cost line, which is always a horizontal line as the fixed costs don't change. In this case, they're £120,000, so go here. Next to go on is the total cost line, which includes variable costs as well as fixed costs. To work out where the line runs to, you need to work out the variable costs at your maximum output. So that will be £80 times 2,000, which gives us £160,000. So run the line from the fixed cost line to 280,000 because it's £160,000 of variable costs plus £120,000 of fixed costs. Next to go on is the total revenue line. So if Chris sold 2,000 surfboards at £200 each, his total revenue would be £400,000. See how the total revenue and total cost lines cross here? This is the break-even point. So Chris needs an output of 1,000 surfboards to break even. If you remember, We've used the same figures for this chart as we did when we just worked out the break-even using the contribution formula, and the two answers match up. So you can, if you want, work out what answer the chart should show to see if your chart is accurate. This area here is loss, and this area here is profit. If Chris's actual output was 1,200 surfboards, this area would be his margin of safety. In other words, a margin of safety of 200 units. Did all that make sense? Why not rewind and have another look at what I did? So what is cash flow? It's really straightforward. It's the flow of cash into and out of a business. A useful example is if we think about ourselves. Probably a lot of us have part-time jobs and get paid at the end of the month. This is what's called a cash inflow. What we spend our money on, like clothes or going out, is our cash outflow. Let's say you earn £200 a month and spend around £150 a month. This seems quite healthy because you earn more than you spend. But problems can happen because you only get paid at the end of the month. So how do you spend what you don't have? Can you see the problem? The bank might let you have an overdraft, but you'll probably have to pay interest on it. Businesses face exactly the same problems, but on a much bigger scale. The timing of money going in and out of a business is crucial because a firm may have made a lot of sales and potentially be profitable, but not yet have been paid for them. At the same time, the business has to pay its bills, so there's a real difference between cash flow and profit. Cash flow is really important in the short term to be able to pay bills. Businesses need revenue to be more than costs to make a longer term profit, so shareholders can be paid a dividend and money can be reinvested in the business. To try and see when there may be cash flow problems, in other words, when outflows are more than inflows, businesses draw up cash flow forecasts. If they can identify times when there may be cash flow problems, they can sort out finance to cover these times. The forecasts might also be used to show to lenders who'll need to know if they lend money, it can be paid back. Let's have a look at how cash flow forecasts are put together. On the forecast, you'll have an opening balance, cash inflows, cash outflows, a net cash flow, and a closing balance. These categories don't have to be in this order, so it's important to know how the forecast works. Let's put these headings onto a forecast. This one will just be for 3 months. Right, we'll put the opening balance here for November. This is how much cash they start off with. Let's say it's £150,000. Then the cash inflows, which can also be called receipts, these are £50,000. Next are the outflows, which can also be called payments or expenditure, and is what the money's been used on. For example, raw materials or loan repayments. For November, the outflows are £25,000. The next thing to do is work out the net cash flow, which means taking the outflows away from the inflows. In this example, the firm plans to have fewer outflows than inflows, so is left with a positive figure. See how £25,000 has been taken away from £50,000 to give £25,000. The last thing to work out is the closing balance. To do this, you add the opening balance and the net cash flow. Here, it's £150,000 plus £25,000. The closing balance of £175,000 then becomes the opening balance for the next month, like this. Let's put in December's figures. The opening balance is £175,000. This time the inflows are £75,000 and the outflows are £30,000. So this gives us a net cash flow of £45,000. If we add that to the opening balance, we get £220,000 for the December closing balance. Now let's do January. The opening balance will be £220,000 because that was December's closing balance. This time they have fewer inflows, only £40,000 this month, but their outflows have increased to £60,000. This means when outflows are taken away from inflows, we're left with minus £20,000, which is shown by putting brackets around the figure. Then the opening balance of £220,000 plus the net cash flow of minus £20,000 gives a closing balance of £200,000. In some exercises, you might have to work out what the inflows and outflows are by adding up what monies were received or what payments were made.